Hello and welcome back, guys. Hope you're having a nice weekend. Today we're going to be taking a look at Beyond Meat, a company that was suggested by one of my subscribers, and it was a huge thing. It was a very trendy stock back in 2019 when it IPO'd. We will be taking a look at the company and do our usual analysis here. First things first, if we take a quick look at the chart here, you will see that in March 14, the company was at about $36 and now it's at 49.3. So people seeing this rise, they're potentially thinking of entering the company. Now this is a month chart. If we take a look at the 6 month, you will see that overall the company has been going down quite a lot, and it used to be about 125 here back in July 19. And if we take a look at the whole thing, when it IPO'd, it was like 62. When it 65, it closed to 65.75. And today is pretty much lower than this. So yeah, as you can see, the company had actually a huge rise, went up to more than $200. So yeah, if you bought at these levels, well, it hasn't been doing well. So the 1 year high has been 160, but again, we are much lower now, getting a little bit of an increase. But let's take a look at the metrics here. Let's take a look at the financials. Now, the P ratio of the company is negative, pointing to a company that is actually losing money. Now, of course, that's not what you want to see, although it does do a little bit better lately, so it at least loses less. Same thing with the price to free cash flow ratio. Used to be less, much more negative. Now it's still negative, but better than what it used to be. But look at the outstanding shares here, 50% increase. They used to have 42 million shares. Now they have 63 million shares. So an insane increase in the amount of shares here for the company. So that's worth noting. It's a huge problem for a new investor, especially for an investor that actually bought over here in 2019. They have been massively diluted. The 5-year revenue growth is increasing, which is the nice thing to see for the company, yet the net income growth and the free cash flow growth are decreasing and decreasing massively. Look at that, decreasing massively. So basically you can already tell that all the earnings that the company has made and free cash flow are coming from investors' money. Just by looking at these key metrics here, and this is why I do love the tool, I can give you all this information super quickly just by glancing at it. And the return on equity, look at this. All these are super negative over here. And the net income margin, again, the company is losing money. Debt to equity ratio, I mean, all these things are pointing to a company that has quite some debt, although they do have a lot of current assets compared to current liabilities. So that's at least good. But look at the price to book ratio. Huge price based on the assets the company has. A little bit better, but it used to be 30 here. But still, I mean, it's insanely overvalued here. Their price, the price of the stock that's based on the assets. That doesn't necessarily mean that the stock is overpriced, though. We're gonna be taking a look at the stock evaluation tool to tell us that, because this way we can actually identify how much the company is making in terms of profit and deduce how much we should be paying today for it. And we do it by examining revenue, net income, and free cash flow. If you haven't seen this tool before, I'm using it a lot in my videos. And this is a tool that I will eventually be giving all of you access, so you may want to subscribe and be around, because I will let you know how to access it very soon, in about a couple of months. And while we're at it, please leave a like also for the video. That really helps, and thanks. So the revenue growth here has been decreasing lately, as you'll see. It's kind of expected. I mean, at some point there will be a decrease in the revenue growth, although it's very early for the company and you would expect more here. Now, the last year hasn't been impressive, but I'm willing to go 14, 16, and 18 for the company, because I think they do have some potential here. And non-meat foods are probably going to be a thing of the future for a lot of people, at least. So net income margins here are negative, of course, and this is the big problem. The net income margins are negative, and this means that the company is not making profit. And when the company is not making profit, there is trouble ahead, because we cannot really deduce how much to pay for it. And let's just say that the company manages to make net income margin of 10, 15, and 20 here, and then we will see what we're having, which is very far from where we are right now. Now the free cash flow margin is a little bit better here, But again, we're talking about negative net income margin, so you cannot really use these values here. Now, typically, we like to see something like 70, 80, or 90 at least. So I'm gonna go with that. And a 30% of annual return just to see what we could potentially get out of this company if it becomes profitable. Now we are projecting profitability here. That's the thing. And if we calculate, you will see that even with very aggressive projections here and actually predicting profitability today, which is not even close, we're getting every projection here being lower than the current price. So that's a big problem. And this points to a company that's very overvalued, and we have to take leaps of faith here in order to purchase it. And even then, we are far below what the current price is. Now, I do want to take a little bit of a look at the income statement and all the financial statements here. You will see that the company's net income, which we examined, has been going down and down and down, which means that they are losing money. And if we take a look at their balance sheet, you will also notice that in the total assets and total liabilities, they are very close here. And so total assets minus total liabilities brings the total equity to a very low number. It's actually lower than last year and 2 years ago, although better than the previous years. The big problem is that all this money comes from additional paid-in capital. As you'll see here, it's 500 million, 560, 510. So the company keeps issuing shares, diluting investors, getting money off of investors and using it to fund their equity pretty much. And that's a huge problem because the company is not making money from operations. Now, the cash flow statement here, you will see that the operating cash flow is also negative and very negative here. And that is a big problem again because this is pointing to a company that is not profitable. And cash from investing also in the negative. And that's a good thing, of course, because the company does invest. It's mostly about capital expenditures. This is normal. Cash from financing, though, look at this, super positive over here in the last year, just because they are getting some debt, it looks like, pretty obviously. They got debt here and also a lot of debt here as well. Look at this increase from the last year. So yeah, they do get a little bit of debt, actually substantial debt based on the free cash flow that they are not making. And also they are getting a lot of funds from investors as well. And you will see here that the free cash flow has been deep in the negative, especially in the last year. Not doing well at all here, and that's the biggest concern really. They don't even seem to be growing here. So what am I thinking about this company? I just can't see myself investing in this one. Problematic. I mean, I don't know if they will achieve profitability and when, but I probably won't be willing to wait for that, especially when the net income is actually going down and down. I mean, the revenue is a little bit better, which potentially points to a company that could reverse the situation. Yet this kind of growth is very minuscule here to see that. So they would have to cut down on a lot of things to maybe achieve profitability here, and maybe operating expenses would be a thing. But this last year, where they made 464 million, which is their best year, they actually lost the most money, 182 million. So that is a big problem for me, and I'm just not willing to follow through with this company. So hope you enjoyed the video and gave you some ideas. Thanks a lot for the suggestion. This was a subscriber suggested company. I have done a video about it some time ago actually, but hopefully that helps a little bit. And if you did like the video, please leave a like, and I hope you enjoyed the video, and I hope you enjoy your weekend. And while you're at it, you may want to take a look at this video that I made earlier, and discusses a Himalaya fund. It's an interesting fund. I'm kind of showing you how to kind of mimic and create a similar hedge fund, sort of a similar fund for your own sake, like a private fund, how you can actually mimic a fund and create your own one based on that fund. So thank you for watching this video, and I'll see you soon. Have an awesome weekend. Bye bye.